to stage. Oh, there we go. I don't know why I'd have to add to stage, but there you have it. I'm here. Uh, so as we kind of spool this up overnight, stocks generally worse. Uh, Looking bad here. Onshore futures, NASDAQ indicating down 2.5 plus 777. Dow only about 35 basis points. S&P down about 1.25 points. Volatility up 13%. Commodities, oil still sub 80, down across the board. Gold off over 1%. Platinum almost 3%. Copper over 3%. Silver over 5%. Dollar up versus most currency. Bitcoin down almost 5%. So markets definitely a bit uncomfortable, if you will. Here at 8:30, no data. We got our our ADP weekly about 13 minutes ago, came in at 30.75, up from 25.5. That's not bond friendly. S&P at 945. So we're trading on thin data. Looks like there was progress with Iran overnight, and the strait is open for business, albeit maybe not as good morning, Bob. Maybe not as freely as one might hope. Apparently, it's like almost a case by case. I don't know, but I think we've de-escalated from the whole, if the strait isn't open, you won't have a home to return to, or whatever the quote was that we kind of woke up to yesterday or came out in the early morning. MBS kind of back to yesterday morning's levels, depending on what exactly yesterday morning means, kind of slightly behind 8:30, but ahead of 10 o'clock, which is where you would have seen most rate sheets print. So long story short, if we were to hold these levels, my guess is that you're going to see maybe somewhere between flat to possibly an eighth better in fee. Up in coupon. I mean, at 957, we were about 5 ticks worse than we are right now. So you could see even as much as 20 basis points. Again, if all things are equal, depending on note rate. 6.5 coupon has rebounded. 6.5 is almost up 25 basis points. So depending on what what rate you're looking at, my guess is that rate sheets will be better today versus yesterday, even though at the moment that we woke up, rates were actually better at or around yesterday's open. But if a tree falls in the woods and nobody hears it, what does that matter? Looking at Fannie's. Fannie's a bit more resilient here on a 2-day chart. We're well above worst levels. 5-day chart, however, we're still about 30 basis points behind midday on the 17th. I wanted to share with you guys this morning. So before we talk about sort of strategy for the remainder of the week, and the remainder of the month, let me share with you, and I don't know if you've had the opportunity to kind of dive in to the Fed. Now, I'm not going to get super into the weeds here. This is 17 pages, okay? But I wanted to share with you a couple things that I found interesting, a couple things that I found curious. What I kind of love is the longer run. I don't necessarily know what that means other than it's beyond 2028. But, the economic projections and so on for the longer run just seem to be just what their central numbers or what they aspire to. So economic projections, okay? So you can see where we've gone, right? Here we are for 26. Now, I think we need to be mindful of the fact that we are halfway through 2026. And so, and this is where when we talk about short run, longer run, volatility trading, building you can't, for us to build our business around what's going to happen over the next 60 days is difficult. I mean, that's being transactional. And we've talked a lot about that, at TAG or other events and keynotes. I'm not talking from a cap market standpoint, just from a business standpoint. If we're obsessed over what rates are going to be a week from now and not what they're going to be, 60 weeks from now, you're not really running a business. You're just day to day. And so, I think that when you look at some of these 2026 predictions or projections that we're going to go through, it just seems to be much ado about nothing. And I wonder, and we talked about, and there is a punchline to this, and it was that where I was optimistic from an interest rate standpoint about what War said was, his willingness, if not desire, to kind of disconnect monetary policy from traditional sensibilities, I'll call it, right? And so, when you look at where we expect GDP to be, right? The consensus, depending on how you look at that, whether it be median or whether it be the sort of central tendency, as you would call it, sees us being sort of, ruminate around this 2% number, which is where we are today, to worse, right? Now, if I pause there for a second, if we're projecting the economy to really not heat up beyond this 2% change in GDP, then why do we need to move monetary policy? I think that's a good question, right? If we've seen an uptick in unemployment and our expectations is for that uptick to kind of continue, if not level out in the near run, right? If it's not going down, right? And we're not at full employment. Again, an interesting question. Here's the chart that I really wanted to talk about is PCE for a second, whether it be on a headline or on a core level. If you assume that 26 is over, right? And believe me, at my age, I'm not trying to rush anything. Why does this matter? Can you, and when I talk about, how, we might, or how you might want to run your business and worrying about where rates are going to be in January, not where they're going to be on July 21st, right? Why do we require any move in monetary policy if we're already predicting inflation to actually go down from these levels in 27? That's to me a big ask. These are the so-called dots. I'm not going to talk about this, mostly because it really only matters to comp it to previous. But this shows you where everybody is. And I'll just put it this way. So, this shows you that on a monetary policy basis, the consensus is that rates will be lower. Maybe consensus is a bad word, but that many believe that rates are going to be lower in 27 than they expect in 26. Now, part of that is because they're expecting a hike here in 26. I guess my question is, why hike? And if we raise a quarter in December, is that really going to set off a chain of events that puts us in a position to it just makes no sense, particularly if we are convinced, and this is what I've been talking about. If the Fed truly believes that inflation is transitory because of Iran, then what are we doing, right? And so this is where I say, I think we need to be cautiously optimistic. I think cautious, the bigger word than optimistic in that statement, that when we get to a point where the Fed was sort of targeting an increase, October, November, December, the data would be such that it would give them pause. And if we were to realize that scenario, just as we saw rates increase precipitously, it would not be a slow move down. And it's not so ironic that for the last 2 years, September has brought with it a precipitous drop in rates. It wasn't a slow march down. And I think that there's a really good chance that that happens again this year. And, you've heard me say this, if nothing else, not because anything real has happened, but because there's sort of this annual deceleration in the economy in the middle of the summer. If you combine that with a deceleration, or even for that matter, a decrease in inflation, which would be deflation rather than disinflation, if those things were to happen because oil is freely flowing and we're drilling, baby, drilling, then again, by the time October comes around, the market totally reprices these increases. Here now, when we get back to kind of GDP, right? Look at where our March projection was, right? And look at where we were in June. A tremendous sort of reprice worse in GDP. Now, there are some that might say maybe it's better in that now we're projecting, there are more people projecting 2.223, right? And fewer people projecting 1.819, but to the high side there, and you hear them say this, are there more risks to the high side or the low side, so on. One would say that the risk to the high side of a hot GDP were repriced way down by the Fed. Somewhat similarly, not quite in 27, and again 28. 28. This is maybe slightly better. Maybe this one's a little harder to say. And then, of course, the BS longer run, basically no change. Unemployment rate, right? Near term, okay, they believe the unemployment or the employment situation is worse, right? Higher unemployment rate. They think it's better, rather. They were projecting here in March, here in June. I think that's reason for concern. But again, what does that matter? Because their projections for 27 and 28 and the longer run are almost identical. This is where it gets a little bit hairy. And again, I say it's 26. Inflation projections way up for 26. But for 27, not so much, right? Definitely risks to the higher side, but not necessarily in a really, really big way. And then 28, about the same, longer run, about the same. Core, repriced up, that is definitely a reason for concern. And so the question becomes, right, if we've marked the economy down, if we've marked employment about the same versus March, but we marked inflation, I would say, generally up. Maybe we're splitting hairs here between 2.1 and 2.5. If the economy is worse, why would inflation be higher if the oil situation is transitory? I think that that's really problematic for me in their projections, and something that if I were if I were in the press and then therefore in the presser, I would want to ask these hard questions, right? And that's where, when I talk about the Fed historically being offside, or the pendulum swinging too far or too hard in either direction, kind of what we just went through, back of the napkin. I mean, it wasn't a super deep dive, is the reason why I just simply don't trust the Fed. Is the reason why I continually say bulls and bears make money, pigs get slaughtered. I have to be mindful of the Fed, right, in my trading. I have to, when I'm trading, I put myself in their shoes, right? And it's that don't fight the Fed thing. So how do I perceive the Fed as we're sitting here right now? Well, I perceive them as hawkish, not because I necessarily think they're hawkish. Again, I keep saying that some of the methodology with which the new Fed is suggesting they're going to approach the economy, I think would have them sort of underrun rates relative to history. I.e., if Bernanke and Yellen and Jay Powell and Greenspan were to see this number, right, would that talk up or talk down rates? I feel like, at least preliminarily, whatever this number is, I think this new Fed would talk down rates a bit more so than previous administrations might talk up rates. But as it sits here now, I still say the defense here is for them to be hawkish, and then for them to kind of have an oh shit moment, as the Fed almost always has, right? Because of their inability to read the tea leaves. And again, I say this, and now I understand that all of these projections perhaps aren't in a vacuum, right? Maybe their downward projection to the economy is because they think they're going to raise rates. I mean, gosh, do we really think that 25 basis point hike is going to result in modern days, right? Not talking about 1938. Is 25 basis points going to really result in 50, 75 basis points in GDP? I don't see it. And I think that the last 24, Ryan, in 26, are you saying that? Please elaborate, and we'll talk about it. The last 3 years have suggested that the economy can do just fine with high interest rates. To me, that emboldens or empowers the Fed and allows them to be hawkish. What I keep saying, however, is that we're wrong about the idea that the economy can run on 7.5% interest rates. And why are we wrong about that? Because Main Street is not running. Right? These numbers are skewed. And that's, I think, a big reason why this new Fed is going to look at things differently. You cut rates 75 basis points tomorrow, and there's no proving this. But I'm going to tell you, for the most part, doesn't do a good goddamn for inflation. Might help housing. And that was an interesting thing that came out, by the way. I forget the article and I forget who said it, and I'd be interested to know, kind of raise a hands or what have you, who saw this. But basically, what I read was somebody, talked about, and I'm going to try to search this, monetary policy only impacts housing. So somebody talked about the fact that monetary policy, right, it effectively just affects housing. You know, let me see if that article changing inflation. You know, I'm going to do a deeper dive and see if I could find that article. But what they really talked about was the direct connection to monetary policy is sort of housing and housing alone. You know, yeah, I just don't see 3 hikes, Ryan. I just don't. You know, I got to tell you something. Bank of America, who I haven't looked recently, right? I'd be pretty uncomfortable if I was Bank of America, because at one point they had the largest amount of held to maturity losses on the books of any institution in America. And I don't know if you guys saw that article, but now while we're way down, at one point our held to maturity losses were something like 600 million. We're down to like 3 billion. We're down to like 319. But why that's noteworthy is it's up from like 306, and it's the first time that held to maturity losses ticked up in the last year, 2 years, something like that. And so if we do have 3 hikes this year, that does not bode well for folks that are holding on to 1.5, 2, 2.5, 3 coupon MBS. Now, we've seen people more willing to pay off those low rate mortgages because they're in debt. By the way, let's revisit my Main Street versus Coastal Elite. You know, this make no mistake. I mean, the Fed is holding as much of this underwater paper as anybody. You know, as crazy as it sounds, you know, is there some motivation to keep rates higher because it forces people to pay these loans off, therefore getting these losses off the books? This is a very, very interesting conversation, a very tangled web. If we're just talking about the economy at large, I am fully and wholly against any hikes this year, much less 3. However, you know, who knows? You know, listen, if oil gets to $60 a barrel, and we are certainly headed that way, it is nearly impossible for these inflation numbers, especially on a core basis, to not get better, full stop. And the Fed has been keenly interested in the inflation numbers on a core basis. I mean, they've outwardly said that they believe that this inflation is transitory. So then the $1 million question is, if the inflation is transitory, why would they have to hike 3 times? The answer is they wouldn't, especially if you consider that the prognosis for GDP isn't great, right, by the Fed's own measure, that the prognosis for employment is still bumping around that mid-4 level that we're at. You know, come September, October, I think that they've got to hike it, you know, now, right? Because I think if they're hell-bent on hiking, because I think once you get to September, I'd really be shocked if there was a strong case to hike come then. So let's wrap it up. If you guys have any, I love the interactivity. If you guys have any more questions, please post them in the chat. You know, 9:45 we have S&P. Tomorrow, nothing at 8:30. Home sales at 10. And then Thursday, as we've talked about, Thursday's the day. Really, all eyes on PCE at 8:30. Hard for me to not make a case. So if you're still not locked up for June, early July closing, 6.25 and up note rates. To me, I don't know why you wouldn't be locked by now. And if you're not locked by now, I think you lock today's dip makes a lot of sense. I think 5.5 coupon, maybe you're a bit more 50-50. I think that if you started floating somebody on May 19th, you are, 75 basis points better. So it's a great story to tell. I think if you're around June 8th, beginning of June to the last week, you're about even. You know what? You took a chance. You didn't win. Might as well lock it. Chasing June 15th's loser, you're off 30 basis points. I guess maybe you're day to day on that. Maybe see if we can continue this rally into tomorrow. And if you're still hanging on to 5.25 to 5 5 1/8 note rate, you are basically smack dab mid board here. This is where I say longer run, I'm almost 100% float on that, because I don't believe that, or I would say that I believe that the worst of inflation is generally behind us, and that my prognosis for rates as we get into the summer is slightly better versus slightly worse. And, I don't mind hanging on, but if you're out of time, you're mid board here. So, just move on. And I don't know why you wouldn't just put somebody move their rate up and position them for a refi at some point, in 27, which I believe is a fairly likely outcome and timeline. So I will see you guys tomorrow. Thanks for joining live. And for everybody that watches on replay, have a great day. Bulls and Bears make money, pigs get slaughtered.